Risk reporting and analytics, interview preparations for risk and regulatory teams. If you are preparing for risk reporting, risk analytics, or risk data roles in banks or financial institutions, this video is built exactly for you. We have created very comprehensive interview preparation material, specially designed for risk reporting and analytics teams, not just generic reporting concepts or BI tutorials. In this session, we go deep into how risk data is transformed into decision-making intelligence, from data validation and reconciliations to VAR, stress testing, sensitivities, dashboards, limit monitoring, and regulatory reporting. You will learn how interviewers expect you to explain risk numbers, data quality controls, analytics logic, and how complex results are communicated to senior management, clearly, confidently, and with structure. Explain the primary responsibilities of a risk reporting and analytics function within a financial institution. The risk reporting and analytics team transforms large volumes of market, credit, liquidity, and operational data into clear, actionable insights. Your responsibilities include collecting and validating data, producing daily, weekly, and monthly risk reports, performing analytics, monitoring limit usage, and escalating breaches or anomalies. You also support regulatory submissions, build dashboards, maintain data quality, and partner with risk managers and trading desks. Your core mission is simple: deliver accurate, timely, and meaningful information so senior leaders can manage risk confidently. Describe the difference between regulatory reporting, internal risk reporting, and management dashboards. Regulatory reporting follows strict templates and rules, COREP, FRY 14, Basel templates, and must match regulatory definitions exactly. Internal risk reporting supports daily decision-making. It shows VAR, sensitivities, exposures, and stress results for desks, portfolios, or legal entities. Management dashboards summarize high-level trends for executives. They highlight key risk indicators, limit utilization, and top exposures with visuals and commentary. Each serves a different audience and therefore uses different levels of detail. Walk me through how you would design a daily market risk report for trading desks. Start by defining the audience: traders, desk heads, and market risk managers. Include core sections, daily P&L attribution, sensitivities, delta, vega, DV01, CS01, VAR and expected shortfall, stress test results, limit usage, commentary on major drivers. Structure the report with clear tables and charts. Add a short narrative explaining why risk moved. The goal is fast comprehension, within seconds, not minutes. How do you ensure completeness and accuracy of data feeding into risk reports? Use structured data checks, completeness checks. Ensure all trades, positions, and market data feeds arrived. Accuracy checks. Compare values with independent sources. Reconciliation checks. Match exposures across front office, risk, and finance systems. Exception reports. Highlight missing or stale data. Data quality is the foundation of trustworthy risk reporting. A key data feed fails overnight. Describe your contingency plan for timely report delivery. First, alert technology teams and start diagnostics. Next, trigger backup procedures, such as using prior day data, partial extracts, or manual uploads from front office systems. Estimate the impact on risk numbers and disclose limitations clearly in the report. Prioritize delivering a reduced but accurate version rather than delaying entirely. Then follow up with a root cause analysis and preventive controls. Explain how VAR, stress VAR, expected shortfall, and sensitivity measures are represented in risk reports. VAR shows the one-day loss level at a confidence threshold, usually 99%. Stress VAR applies VAR methodology to stressed historical periods. Expected shortfall shows the average loss beyond the VAR threshold, a better measure of tail risk. Sensitivities translate complex positions into simple risk units: delta, gamma, vega, DV01, CS01. Reports typically display these metrics for the entire portfolio, each desk, and top positions. How do you validate that risk numbers, example, Greeks, DV01 and CS01, match front office and risk systems? Use a bump and revalue approach. Manually increase a market parameter, such as rate or price, and revalue the position. The resulting P&L change should match the sensitivity. Also, reconcile positions and trade attributes across systems. If numbers diverge, investigate market data differences, model versions, or missing trades. Validation requires independence and repeatable testing. Describe the key components of a credit risk dashboard for senior management. A credit dashboard should show counterparty exposures, limits versus usage, top obligors and industries, credit ratings and migrations, expected loss and unexpected loss trends, concentration risks, stress test impacts, watch list or deteriorating names. Use clean visualizations so senior leaders can spot risk spikes quickly. How do you identify and highlight emerging risks using analytical techniques? Use techniques such as time series trend analysis, correlation shifts, volatility clustering, scenario comparisons, and machine learning anomaly detection. You look for unusual patterns, a jump in limit usage, rising correlation between assets, increased margin calls, or rating migration patterns. Emerging risks become visible when trends break from historical norms. A senior stakeholder challenges a risk figure. Walk me through how you investigate and respond. Start by recreating the figure independently. Verify the underlying data, positions, market data, parameters. Check system logs and reconciliation reports. If the number is correct, provide clear evidence, screenshots, calculations, and assumptions. If the number is wrong, correct it quickly, explain root cause, and prevent recurrence. Always respond factually and calmly. Explain how regulatory risk reports such as Basel III/4 templates, COREP, or FRY14 are produced and validated. These reports follow strict definitions for exposures, capital charges, and liquidity metrics. Production steps include extracting data from multiple systems, applying regulatory rules, aggregating exposures, and filling standardized templates. Validation includes reconciliations to the GL, consistency checks across schedules, reasonableness checks, and sign-off from senior risk and finance teams. Accuracy is essential because regulators use these reports to judge bank stability. Describe the role of data governance in risk reporting. Data governance ensures that data is complete, accurate, timely, consistent, and controlled across its lifecycle. It includes ownership assignment, data dictionaries, quality rules, lineage documentation, and audit trails. Without strong governance, risk reporting becomes unreliable and prone to misinterpretation. How do you handle reconciliation between P&L reports and risk metrics for consistency checks? You compare P&L drivers, delta, vega, DV01, with risk sensitivities. If P&L changes cannot be explained by sensitivities and market moves, investigate. It may indicate misbookings, stale data, or incorrect risk metrics. The goal is alignment. The risk metrics should reflect the same exposures that drive P&L. A limit breach appears in the report. What actions do you take? First, verify the breach. Check data, positions, and thresholds. Notify the risk manager and the desk immediately. Include comments in the report explaining the cause and materiality. Track remediation, reduce exposure, hedge, or seek temporary approval. Limit breaches require fast escalation because they signal heightened risk. Explain how scenario analysis and stress testing results should be incorporated into regular risk reporting. Include stress results alongside VAR to give a broader view. List top vulnerabilities, interest rate shocks, equity drops, credit widening, or FX devaluation. Show the largest losses under each scenario and explain drivers. Stress results help senior managers prepare for low probability but high impact events. Describe how you use trend analysis to identify deteriorations in a portfolio's risk profile. Trend analysis looks at changes over weeks or months. Metrics include VAR trends, sensitivity buildup, credit migration patterns, increasing concentrations, widening spreads. If trends move consistently in one direction, it signals rising risk even before limits breach. Trend analysis reveals slow-building issues early. Walk me through generating rolling volatility or correlation metrics for market risk analytics. Use time series windows. For example, 30-day or 90-day periods. Calculate daily returns for each asset. Then compute standard deviation, volatility, for each rolling window. For correlations, compute covariance between assets within the window. Then divide by product of volatilities. Rolling metrics capture regime changes that static metrics miss. How do you perform backtesting of VAR and report exceptions? Backtesting compares daily P&L to VAR estimates. If actual loss exceeds VAR, an exception occurs. You analyze whether the exception reflects market volatility, model weaknesses, data issues, or unusual trading activity. Exceptions are reported to regulators, internal committees, and model validation teams. Too many exceptions indicate underestimation of risk. Describe techniques used to validate large datasets before constructing risk reports. You apply completeness checks, duplicate detection, threshold checks, distribution analysis, and outlier detection using statistical rules or machine learning. Cross-source reconciliation, such as comparing trades across systems, is also essential. Only validated data should be used to generate risk metrics. Explain how you would automate a manual risk reporting process using tools like Python, SQL, or Tableau. Begin by mapping the workflow: data extraction, cleaning, calculation, reporting, and distribution. Automate data extraction with SQL queries. Use Python for transformation, validation, and metrics calculations. Push results into Tableau or Power BI for dashboards. Add error logs, audit trails, and scheduling. Automation improves accuracy, consistency, and speed. Risk reporting and analytics. Interview preparation. Part 2, questions 21 to 40. TTS-friendly, explanatory, patient-teacher style, with natural pauses and simple examples. A new trading product launches. How do you adjust risk reports to capture new exposures? Start by understanding the product's risk profile: delta, vega, basis risk, curve risk, correlation risk, or liquidity needs. Meet with the front office, product control, and model validation to confirm valuation methods and risk factors. Next, ensure your reporting systems receive correct trade attributes. Update sensitivity calculations, VAR mappings, and stress test assumptions. Finally, update dashboards and limit frameworks so the product appears correctly in all reports from day one. New products must never create blind spots in risk reporting. Describe how to design KPI, KRI dashboards for operational or liquidity risk. KPIs, key performance indicators, measure how efficiently processes run. Examples include processing times, system uptime, or reconciliation completeness. KRIs, key risk indicators, warn of rising risk. Examples include failed trades, near misses, staff turnover, or liquidity buffer usage. Dashboards should use simple visuals, heat maps, traffic lights, trend lines. They should highlight exceptions clearly and provide context for escalation. The goal is dynamic monitoring, not static reporting. Explain how risk-weighted assets, RWA, are calculated and reported for trading versus banking books. For the trading book, RWA is driven by market risk models: VAR, stressed VAR, incremental risk charge, and default risk charge. For the banking book, RWA comes from credit risk, operational risk, and standardized or IRB approaches to borrower exposures. Reports must break down RWA by asset class, business line, and driver. Consistency with regulatory definitions is essential. How do you ensure regulatory submissions align with internal metrics and risk frameworks? Run reconciliation checks. Do internal exposures match what is reported externally? Review definitions carefully. Regulators often define concepts differently from internal systems. Perform consistency checks across templates: liquidity, capital, leverage. If numbers diverge, investigate data lineage and logic. Alignment prevents regulatory findings and misinterpretation of risk. A sudden spike in stress test losses appears. Walk me through how you analyze and explain it. First, confirm the input data: positions, sensitivities, and market shocks. Next, break down the stress loss by risk factor: rates, credit spreads, FX, equity, or commodities. Identify whether the spike comes from new trades, changed correlations, or increased concentrations. Provide clear commentary: what changed, why it changed, and whether it requires action. Stress spikes must be explained quickly and precisely. How do you communicate complex quantitative results to non-technical stakeholders? Use plain language and focus on the so what. Instead of explaining equations, say, exposure to long-dated interest rates increased, which makes earnings more sensitive to rate hikes. Use simple charts rather than large tables. Summarize with takeaways: impact, trend, and recommended actions. Clear communication builds trust and ensures decisions are informed. Describe methods to detect data anomalies or outliers that could distort risk metrics. Use rule-based checks, threshold limits, sudden jumps, missing values. Apply statistical tools: z-scores, variance checks, distribution analysis. Use machine learning methods: clustering, anomaly detection models to flag unusual patterns. Cross-check against external sources or historical behavior. Outliers must be corrected before risk metrics are calculated. Explain the role of ETL processes in risk reporting infrastructure. ETL, extract, transform, load, moves data from source systems into risk reporting systems. Extraction gathers trades, positions, and market data. Transformation cleans, validates, enriches, and formats data. Loading delivers final datasets into reporting databases or dashboards. You design ETL with controls: logging, reconciliation, exception handling, and automation. Reliable ETL ensures risk reports are accurate and repeatable. How do you test and validate new risk reporting models or analytical tools before deploying them? Follow a structured approach. Unit testing: check individual calculations. Regression testing: ensure new code doesn't break old logic. Parallel runs: compare old and new results over several cycles. User acceptance testing: confirm usability and interpretation. Documentation: describe assumptions, data lineage, and limitations. Deployment should be controlled with rollback options. A report shows inconsistent exposures across business lines. How do you troubleshoot and reconcile? Start by checking trade counts and notional amounts. Are the same positions reported differently across systems? Next, compare market data sources and valuation dates. If data is inconsistent, exposures will diverge. Verify currency conversions, aggregation logic, and system mappings. Once the root cause is found, apply corrections and update controls to prevent recurrence. Describe how machine learning or advanced analytics can support risk identification. Machine learning can detect patterns humans might miss. Examples include clustering unusual trading behavior, predicting credit deterioration, identifying outlier price moves, or detecting data quality issues. Natural language models can analyze news or reports for emerging risks. Advanced analytics enhance, but do not replace, expert judgment. How do you balance data granularity versus report usability when designing dashboards? Too much detail overwhelms users. Too little detail hides risks. Start by identifying the audience and their decision needs. Provide high-level summaries with drill-down options. For example, click a portfolio to see desk-level or asset-level details. Use filters, grouping, and tooltips to keep the main view clean. The goal is clarity with the ability to explore deeper. Explain how you maintain documentation and audit trails for all risk reporting processes. Document data sources, transformation logic, calculations, assumptions, and distribution procedures. Maintain version-controlled repositories for scripts and dashboards. Keep logs of daily runs, overrides, breaks, and fixes. Documentation ensures transparency, reproducibility, and audit readiness. How do you manage version control and distribution for automated or recurring reports? Use tools like Git for version control. Every change must be tracked, reviewed, and tested. Automate distribution with scheduled jobs, secure folders, or dashboard refresh cycles. Ensure that users always access the latest approved version. No outdated files floating around. Version control prevents inconsistencies and audit issues. A critical KPI has stopped updating correctly. Describe your debugging process. Confirm whether the source data has changed, missing files, new formats, or source outages. Check transformation logic for errors, merge keys, filters, or calculations. Run the KPI module standalone to isolate the failure. Review logs to identify exceptions. Once fixed, rerun the full workflow and validate the number. Always document the root cause. Explain how risk appetite metrics are incorporated into reporting frameworks. Risk appetite defines acceptable levels of risk for the institution. Dashboards must compare actual metrics, VAR, sensitivities, credit exposures, liquidity ratios, with appetite limits. Use visual flags to show breaches or near breaches. Include commentary explaining whether exposures align with strategic goals. Risk appetite turns reports into decision-making tools. Describe how you track and report structural breaks, regime shifts, or volatility changes in markets. Use rolling metrics, volatility, correlations, stress results to identify sudden changes. Monitor macro indicators such as inflation, yield curves, and credit spreads. If structural breaks appear, for example, volatility doubling, highlight this in commentary and adjust models if needed. Markets move in regimes. Reporting must capture these transitions. How do you evaluate whether risk metrics are aligned with current market conditions or outdated assumptions? Review model inputs, curves, volatilities, correlations to ensure they reflect recent market behavior. Run sensitivity tests to see if metrics respond realistically. Compare metrics with external benchmarks and peer data. If assumptions look stale, escalate to model risk or methodology teams. Metrics must reflect today's market, not last year's. Provide an example where your analytics identified a hidden or emerging risk. Here is a simple hypothetical. You observe that a portfolio's correlation between equity and credit spreads has risen sharply over weeks. This increases the likelihood of joint downturns. You highlight this emerging risk, leading senior managers to reduce concentrations and increase hedging. Analytics turned a subtle trend into an actionable insight. Explain how you collaborate with technology, data, and risk teams to continuously improve risk reporting quality and efficiency. You work with technology to automate workflows, improve ETO, and strengthen system reliability. You partner with data teams to enhance data quality, lineage, and governance. You collaborate with risk managers to refine metrics, update models, and improve dashboards. Regular feedback loops ensure reporting evolves with business needs. Reporting is never static. Improvement is continuous. Risk reporting is not about producing numbers. It is about producing clarity. This was a complete, end-to-end interview preparation guide, created specifically for risk reporting and risk analytics roles in financial institutions. If you followed this entire session, you now understand how risk data flows, how analytics detect emerging risks, how reports are validated, and how insights are delivered to decision makers. Rewatch the data validation, reconciliation, dashboard design, stress analysis, and escalation questions. Practice explaining them simply, because clarity, accuracy, and confidence are exactly what risk reporting interviewers test. For more deep, role-specific preparation across risk reporting, market risk, credit risk, liquidity risk, and banking analytics careers, stay connected. And once again, do watch, revise, and master this material.